In episode 451, we talked about the type of life insurance policy that provides the best protection, the blue ring. In today's episode, we talk about the green ring, savings.
The savings rate is up just a little bit in the US in the last few months, but it's still much lower than it needs to be. Generally speaking, people are not saving enough money to give them financial peace of mind.
And when people do save, there's a whole host of decisions needing to be made about how to keep the money.
There's really two camps when it comes to saving: people who aren't saving and people who are.
So let's just speak to that first camp just for a few minutes. If you're not saving, you really need to be. And we talk about the 10-20-70 rule, where people take their income and 10% is theirs to keep. So 20% is for paying off debt, 70% for living expenses, but 10% is yours to keep.
And what is 10%? How do we come to that calculation really quick?
You move the decimal over one place to the left. So if you're making $400 a week, you move it over. That's $40 a week you should be saving. If you're making $10,000 a month, then you move that over one decimal place. That's $1,000 a month that you should be saving.
Well, that sounds like it for somebody who's on a tight budget and having trouble saving. That sounds like a big change. But we don't find that people who actually commit to doing this, they come back to us after they've been trying it for a while and they said, we really didn't even miss the money that much. They find a way to make it work.
When they're committed to it and disciplined to follow it, when they have motivation to do it, they get it done.
So you've got to start somewhere. People who aren't saving kind of tend to fall in the category of expecting something big to come along and save them from whatever's happening. But you got to start with where you are right now and start saving that 10%. That's what's going to help you get ahead financially.
So if you're not saving right now, start saving whatever you can. Try to make it 10% and keep it someplace. It can even be in a coffee can.
Which reminds me, we've got the book, Grandma's Coffee Can, written by one of our daughters about your great-grandmother.
So my great-great-grandmother, she was being taken advantage of by a neighbor who didn't know how to save. But my grandmother was very wise about how to keep her coffee. And so this is a story about savings. It's good for children. It's written, it's animated for children. But if you're not saving, this is a book for you as well, because it'll teach you the value of saving.
Savings is super important. It is how you get ahead. Now, once you start saving, then what do you do with it? Do you keep the cash in a coffee can? Do you keep the cash in a safe? Do you keep the cash in a bank?
Well, let's talk about some of the things that, what if you do keep it in a coffee can or keep it in a safe? Maybe a safe is a little better because it would be protected maybe against fire. What are some other problems of keeping money in a safe?
Well, it's too accessible. A lot of people don't have the discipline then to keep their hands off of it if it's so close to them. If it's just in a coffee can or a safe or maybe their freezer or under their mattress, they're digging into that because they can't discipline themselves to keep their hands off of it when a desire comes up or something that they want to spend that money on.
So what if you have the money in the safe and maybe you are disciplined, but then you come back 2 years later and the money in the safe that you put in the safe is still just the money you put in the safe. And what is happening on the outside of the safe is inflation.
Oh, absolutely. Yeah. Just in the last 2 years, inflation has eaten away about 20% of the buying power of our dollar.
And most people realize this, even just going to the grocery store, costs go up. You go to the gas pump, costs are up. So we see that inflation happening all around us. Guess what? It's happening inside that safe also. So putting money in a safe is not safe from inflation.
Right. So that encourages people. That's actually counterproductive to saving because it encourages people to spend while their value is high today, value of the dollar. And so if you're going to get ahead financially, yes, you have to save, but you have to save in a smart way so that your savings isn't just sitting around. But one of the things that is helpful when you are saving is that you're ready for opportunities that come along.
That's true.
That's a positive benefit because oftentimes when you go to buy something major, there can be two prices. There can be a cash price and there can be the listed price. sometimes when you have extra cash on hand, there's room for negotiation.
Well, I remember, Michelle, when we were saving to buy a travel trailer to move across country, and we just
Many years ago.
oh my goodness, it was like 25 years ago now, and we would just take a percentage of what came into the clinic, and we would set it aside in a savings account so that when we were ready to purchase, we had a cash offer, because there's two prices to everything. There's the cash price, and there's the negotiated price, or the sticker price and the negotiated price. And if you've got cash, guess what? You can negotiate the price.
So it's interesting too, though, when you put your money in a safe or coffee can or mattress or wherever you're saving that money for that particular purpose, you've saved it, and then you take the money out to go purchase whatever that was. In our case, back then, it was that travel trailer. Well, now we're starting at ground zero. We have no money in the safe, nothing to fall back on, nothing for another opportunity. And, before in a previous episode, we talked about having a cash cushion. And when you've used that money, then now you have no cash cushion. So that presents one of those challenges. And what are you earning on the money that you had saved? Well, you're not earning anything. Again, we talked about
safe, you're not doing
it's going down with inflation.
The other problem with saving money in the common places that people want you to save, like CDs and 401ks and IRAs and TSP plans and those type of things, is Willie Sutton. Willie Sutton was a bank robber years ago, and it's reported that he was asked, "Why do you keep robbing banks, Willie?" And his reply was, "That's where the money is."
Yeah, that's where they
And
keep the money.
today, the government knows where our money is, and they're going to steal part of that money from you. They might be deferring the taxes on it now, but they're only deferring it because they know they're going to collect more from you when you start taking it out, or if you die and leave that to someone as an inheritance.
Some of the programs that are out there for savings, they call it, also have penalties if you want to get it out before the appointed time that they allow you to take it out. And part of that is because they know if you wait till that allotted time, they can collect more in taxes. So they're going to penalize you if you take it out early. And
So there's a
thwart their
liquidity
plan.
problem, you're saying.
Yes,
And,
absolutely.
money in a coffee can, there's no liquidity problem. We can get it real easy.
Mm-hmm.
401ks, IRAs, well, now we got a liquidity problem because we can't get to it real easy except for certain defined government special issue products.
Those are
that we buy.
definitely investments, but they don't really match up when you think about the qualities of a good savings program,
That's right.
because you can't,
Yeah.
you don't have that access.
Yeah.
Exactly.
So if we have money in the bank, maybe we
Well,
have it.
that's more accessible if it's in the bank.
Yeah. And you might be able to get a little bit of an interest rate, not enough to counteract inflation, but maybe just, a little bit more there. You will earn, or you will pay tax on anything that you earn in there.
Of course, if it's in a CD in a bank, then you've got liquidation
Yeah.
problems
You have an
too,
access
because-
problem again.
or if it's in the bond market and you want to get the money before the bond matures, you're going to have an issue as well.
So what are the qualities of an ideal savings program? Because you've got all these different instruments that are billed as savings or investment programs, but what are the points that we're looking for our benefit?
Well, most people want their money to be protected. They want it to be safe. They want to earn a good yield, maybe a little bit above average or at least average. They want the money they put in to be the first money they take out, so they're not paying exorbitant taxes.
Mm-hmm.
They would like to earn dividends with the institution that's protecting and holding that money. If that institution becomes profitable, they'd like to share in those profits. It's their money
Why
that's
not?
making them profitable, right? They don't want any limitations on how much money they can put in, which a lot of government-sponsored plans say, oh, you can only put in this much, now you can't put in anymore. So there's lots of things that people are looking for, but very few of the traditional things that people go to save money in allow you to get all of those ideal components of saving to be available for you.
So when we're thinking about guaranteed growth, I guess you would have that if you bought government bonds and held them for the entire time.
Or a
Then-
certificate of deposit.
Yeah. But then you give up the access to your money over
Yes.
that time. If we think about some of the other benefits, people might want a death benefit if they're saving their money here, and if something happens to them, they'd like that to be multiplied for their family in many cases. Now we're talking something with a life insurance
Yes,
component.
yes. Now we're talking about whole life insurance that is going to guarantee a death benefit for as long as you live, not just through a certain period of time, but for your whole life. And one of the things with whole life insurance, we haven't used the word guaranteed. So we talked about we'd like to put our money into a place where it's going to be growing.
Yeah.
But with whole life insurance, not only is the money growing, it's guaranteed to grow. And
Wow.
you can't get that in a bank account. A CD, yeah, they give some guaranteed growth, but you have to lock up the money for a certain period of time and have all those regulations. And it's short term.
Yeah.
It's not a long-term thing. So, but whole life insurance, you get guaranteed growth
So
for the
I'm
as long
going
as
to
you
play
have it.
devil's advocate
you're
here,
not giving
because
up
a
the
lot of people will
availability.
say, well, how can anybody guarantee anything in today's world?
Well, contractual law, insurance company uses contractual law to make that guarantee. You sign, it is a contract. They cannot change it. You could make changes to it. You could end it, but they cannot change it.
So the contract is what makes this different, because the contract guarantees there will be a certain amount of money there at a certain time if these premiums are paid. Whereas in a speculative agreement, if you put your money in there, there is no contract saying, yes, you will have this money at such and such a date in the future.
So it's about as guaranteed as anything that we can get in the financial world today.
It
Right.
is.
And, there are people out there that say, well, maybe it's just going to be even worse than that. Maybe contracts aren't going to be honored. Well, if contracts aren't honored in the US anymore, then we have worse problems than just having whole life insurance policies. Let me just say that.
So when you look at all of these qualities, so many of them stack up in favor of using participating whole life insurance in your savings program. It just makes sense.
It is the best place to keep money, because let's just talk about the difference between keeping and savings. Michelle, you and I keep our relationship. If we don't keep it and nurture it and pay attention and cultivate it and, give fine detail to it, guess what? We're going to end up trying to save our marriage.
Ooh, that wouldn't be good. And you know what? That happens a lot of times as people, you hear stories of people raising their kids and, going through the school years, and then their kids grow up. They leave home, they're off on their own pursuits, and the couple suddenly looks at each other and feels like they don't know each other. And sometimes that ends even in a divorce because they haven't kept up their own relationship while they were busy doing other things. They haven't nurtured that relationship and kept it. And that is really sad. Then they lose what they have because they didn't keep it. And so you're saying the same thing happens with our money.
It does. Money is just an extension of ourself. And if we don't keep it and nurture it and cultivate it and really water it and really pay attention to it, then it's going to disappear, and we're going to try to grasp straws to get it back, or to try to save it. And as it's slipping through our fingers like oil in your fingers, you can't grasp it at that point. It's already gone. The principles and the discipline it took to keep that have not been exercised, and so there's no way, and it just slides right through.
We've been talking about having savings. That's good. But really, we need to talk about how to keep that money that we have saved from our regular spending. So now we need to talk about keeping it.
Because if we don't save, then there's nothing to keep. And if we don't keep, then there's no growth in what we are saving. And if we don't have growth in what we're saving, then inflation and Willie Sutton and all those other people are just going to steal it, and we won't have any money anyway.
And life insurance is the best place for us to keep our money
It is.
because of those guaranteed savings, because of the accessibility, because of all those benefits that we just talked about.
You mentioned buying a trailer. Now that we have cash in participating whole life insurance, what are some of the things that people have used that ready access to cash for to build upon the opportunities that come along in their life? You talked about the trailer that we bought. My brothers, Ben and Jesse, they had access to cash in their life insurance policies. They were able to access it quickly and buy out a fabrication shop. A great amount of
It
equipment.
was like a
wonderful
fire
deal.
sale. Yes.
Yes, exactly. We have clients who have used this money for making down payments on homes or to pay off real estate loans that they have when the interest rates went up.
I'm thinking of Randy in Washington, as you're talking about, who uses a policy loan against his money that he's keeping there to invest in real estate and earns a 10 to 15% return on it.
This solves the problem that you were talking about earlier about cash in a safe not earning anything, because in a whole life insurance policy, you're still getting the guaranteed growth while you're using the money from the policy loan. And so you don't have to give up the growth in the life insurance, the savings aspect, if you have another opportunity come along. And when that opportunity pays off, then you can replenish your savings and start the process over again. So it's not that you have to choose either or so much. When you have a life insurance policy, you get to choose both more often.
Well, we should talk about the best kind of life insurance policy and the best kind of strategy for funding a life insurance policy. But first, let's take a break.
Did you ever play with a set of these rings growing up? They make a great visual picture of how you should set up your finances. On top, you have the higher risk investments, the lower risk investments. This ring is debt, this ring is savings, and this ring is protection. This stand represents the economy. If there's one thing we know about the economy, is that it will change, and it does, and this can change. It's unstable. What some people do when they set up their finances, they take and they go for the shiny, high risk, potentially high yield investment. Now, potential return does not mean probable, and it is definitely not probable. So this doesn't perform as well as they hope, and they think they should add a more conservative investment that actually might return something. So they add that, and believe it or not, some people will go into debt for that. Add that to the debt they already have, and there's their debt ring right on top of that. If you are listening to this podcast, I hope that you have time to click the link in the description for the YouTube video, and we'll tell you where in that video you can see this demonstration, because it really comes alive when you see it. Well, you have these three negatives, these investments that aren't returning as well as you had hoped, and your debt, which is just a draw on your finances. And people think, oh, I should probably save something. So they add savings to that. Then they look at what they have going there. It looks a little precarious. So they plop some protection right on top of that. Well, if there's one thing we know about the economy, is that it will change. It is uncertain and unstable. And as soon as it changes, you lose your protection and your savings, which are the two things you want to keep most. That's the importance of doing it right. Start with protection. That makes a nice foundation for everything else you do financially. Once you have protection in, then add your savings program so you can keep more of the money you make. Next, make sure your debt is handled. Pay off the bad debts, keep the good debts. A good debt is one that gives you a tax advantage or limits your opportunity costs and allows you to make money. Once that's handled, you can do an investment. Hopefully this is something you know about, because those type of investments that you know something about tend to return better. And if you have extra cash flow and want to go for one of those potential high risk, high reward investments, then you can do that too. Now, when the economy changes, you're much more secure. At McPhee Insurance, we specialize in helping people set up this layer, the protection layer, the foundation for what they do financially. We specialize in designing and selling whole life insurance that becomes this protection layer for you. It's a good foundation for everything else you do financially. If you need life insurance, or if you need to get a life insurance policy you already own reviewed, we can help you with both of those things. Contact us by phone at 702-660-7000, or you can email us, team@mcpheeinsurance.com.
With good life insurance, you will have proper protection and also give yourself a head start on your savings program.
The best kind of life insurance for your savings program, bar none, is participating whole life insurance that's designed for high cash value and is subject to earning dividends.
Designed for high cash value. That was a great phrase. And when we design policies for high cash value, we're using a paid up additions rider.
Yes, the highest cash value that you can get in a life insurance policy would be a single premium policy, which is a policy that is completely paid for with one premium.
Oh,
All of it is paid up insurance,
That's
every
nice.
bit of it. But the problem is the IRS says, good, we'll just tax you on it when you use it. And we'll tax you on the dividends that you earn as well. And so that is a good tool for some people in some situations, but it's not the ideal thing for using your money and keeping it and making it grow throughout a lifetime.
So what does somebody want in a life insurance policy when they want a good savings tool?
They want something that has the lowest death benefit, because this is a savings program. It's not necessarily just for life insurance.
Okay.
We might be augmenting this life insurance policy with a term life insurance policy on the side to make sure that they have their life income covered for their family.
Okay.
So the lowest death benefit possible with the highest premium that's affordable and comfortable for the person buying the policy. And we want the cash values to be as high as possible without getting the IRS all greedy.
So follow the IRS guidelines, but get as much cash value as you can in there and the lowest death benefit. Sounds pretty simple.
It is very simple. And then there's the policies that are designed by certain agents that say, okay, well, let's get even higher cash value. But to get that higher cash value than what the IRS allows, they put a term rider in the whole life insurance policy instead of keeping that term to the side like we would do. And what that does is it increases the cost of insurance in the policy. And that cost of insurance never is recovered because that term insurance never becomes paid up. So if we're talking about this and looking at it like a mortgage, the paid up insurance inside a whole life policy is like an extra payment on the mortgage. It builds equity just like that. There's no interest involved in it or anything. Whereas the other part of your payment, the regular payment on your mortgage, every time you make that, a little bit of the mortgage becomes paid off.
Mm-hmm.
And so in a whole life insurance policy, that portion is comparable to paying the base insurance premium, which the IRS requires you to have a certain amount based on your age and the premium you're paying. Otherwise, the policy will become taxable.
Okay. So the base part of the policy, like buying a mortgage, you're building equity over time, and then the paid up rider that you're adding to build the higher cash value, could we say that's like making an extra payment?
Absolutely. It is.
So you're paying off your mortgage a little bit early to build equity faster.
And we can make those extra payments quicker, earlier in the contract. And that's not necessarily the best either, because if we add too much too early, then the IRS limits how much cash value can be developed in the front years. And that's where we want the money, because that's when we want to be able to manage and keep and nutrients and cultivate that money to make it grow.
Well, the cool thing about life insurance is that when you make an extra payment with the paid up additions rider, it actually helps the policy to grow bigger over time. If you make an extra payment on your house, it's not going to help the value of your house to rise.
That's correct.
So it's fundamentally different.
And the other thing is that we're dealing with a guaranteed contract here. And you buy a house and make extra payments, hoping that you'll get it paid off and you'll have more equity. Now you're subject to the market. And a lot of people found out in 2008 and even just a couple of years ago that the equity in their house isn't worth what they paid for the house.
Yeah.
So that happens too. In a life insurance policy, a whole life insurance policy, that will never happen if you pay your premiums on time and pay the interest on any loans that you take.
So getting some of a paid up rider in there to build equity faster, that's a great thing. Why isn't more better? You talked about adding the term rider to do these 90-10 policies that a lot of people are talking about. Why isn't that such a great thing?
Well, if you just want to give all the control and cultivation and nurturing of that policy over to the insurance company and not take any responsibility, then doing a 90-10 or an 85-15 policy.
Yeah, 90-10 isn't really possible with the products nowadays. It's more like an 85-15.
85-15, yeah. Then
And when you're saying that, they're talking paid up additions to base insurance.
that's
right?
correct.
Okay.
Then that's fine. That might be fine. The insurance company will take good care of that, and your cash values will grow. Your dividends are going to be a little bit less. Your dividends are going to buy a little less paid up insurance if you do that over the life of the contract. But it's better than maybe a traditional savings account because you're not going to get taxed on it.
Okay. But that's for somebody who doesn't want to use the money.
That's someone that's
Put it
given the
away.
responsibility completely to the insurance company and say, I'm just going to buy this premium. I'm not going to do anything else with it.
Okay.
All right. But if you want to practice the infinite banking concept You want to take responsibility for nurturing and cultivating and making that money grow that's building in that policy above and beyond what the insurance company can do for you, then you don't want an 85-15 split.
And if you want to access those funds and be able to use them during your lifetime, then it's really better to go with the first kind that you talked about, not that higher split.
That's right. And the reason that is there is interest involved when you take a policy loan against your cash values. And that interest then has to be calculated to see if it's going to cost you more than what the 85-15 policy produced for you.
This reminds me of people that want to invest in real estate, and they have this lump sum of money come in, and they come to us and they say, well, we want to get this all into life insurance as quickly as possible so we could take a big policy loan and go invest in our real estate because we know the life insurance will grow over time. Well, it's true the life insurance will grow over time, but if you're putting all of that into a life insurance policy that's brand new, it's not going to be growing fast enough to overcome the interest when you borrow it all back out again.
That's correct.
And so that's why a more traditional policy design where you have a high paid up additions rider like you've been talking about, but not artificially inflated with that term rider, you get something solid going, but then you use the money, the big lump sum, go ahead and invest in the real estate, get that started so you're not losing time. And then you'll be able to use profits from that to help continue funding the life insurance premiums over time. Over time, that money will get into the life insurance policy, but it'll just happen more sustainably.
And, another thing, too, is that a lot of agents will tell people, well, let's premium finance this policy because the cash value growth is going to be such and such at such and such a time in the future. You can borrow this money and make the premium payments, use the money, that the cash value, and go make money. Now we got two interest rates involved.
Yeah.
You got the premium finance charge and you've got the policy loan charge. So if those aren't calculated into what you're going to do in the future with the cash values that you're going to leverage, you're probably going to end up on the short stick.
And I haven't been hearing as much about premium financing here recently as interest rates have risen, because a lot of those loans for premium financing are variable rates. Those interest rates are going up, and people aren't really excited about premium financing so much anymore, I don't think.
Yes, but something that is starting to arise again is reverse mortgages for older people.
Yes.
And now we've got an interest building there that's tearing down the money that's going to be available for that person. So all that we're saying here is that just because someone says it's something good to do, you've got to look into the details. That's where the meat is in the details.
So
Sweat the small things.
And I feel like we've been talking about a lot of abstracts here, and my mind has just been kind of picturing when the insurance companies come out with a new product or their products are changing, then we go and we look at those products and we start working with the design. And you, Tom, are often buried in numbers, columns, rows, working out all the numbers so that you understand that product and understand how we're going to be able to help our clients, the people who call us. How are we going to be able to help them with these products? So you get all that figured out so that you understand how the product works. And then when you meet with people, you can explain what's going on, and the designs that are going to yield the highest cash values for them, policies that we would buy, and what you can recommend to the client.
I remember sweating that myself when we first read the Infinite Banking Concept by Nelson Nash.
Becoming Your Own Banker.
Becoming Your Own Banker. I was thinking, boy, how do you find these policies? And we went home and because we were on vacation when we read that book, and we dug through we were trying to find a mutual participating and it was just frustrating. And finally I called the agent that had sold the book to me. I said, where do you get that? He says, we've done the research for you. Okay. Now, what's really fascinating, that policy I bought from that agent just a couple of years ago, I paid the premium on it. It was $10,224 for the year. My cash value grew that year by $17,000, which is a 66% return on my annual premium.
Cool.
That is a well-kept policy. It's keeping my money very well. And that happened even though I have nearly $140,000 borrowed out against that policy. So borrowing my money didn't negate the growth that is guaranteed to happen in that policy.
Being able to work with people who already understand the insurance products can save you time and help you get it set up faster. And time is so important. when it comes to building wealth for the future. Benjamin Franklin is reported to have written to a young tradesman who was asking him for advice. He said, "Remember, time is money."
It is. And we can't make more time, but we can make more money, which basically fulfills what the Apostle Paul wrote to the Ephesians is the days are evil. Be careful with your time so that you make more time, basically. And the way we do that is be resourceful and being creative. And we're all made in the image of God. We're all creative people. We can make this work for us. We don't have to depend on the experts, but we do have to get educated.
A great example of time when it comes to money is somebody who starts saving $1,000 a month. They save for 5 years, earning 5% interest, and then they stop saving, just for the purpose of our example here, because second guy comes along, he starts saving when the first guy stops.
So 5 years in.
5 years in.
One did for 5 years, then another one doesn't start till 5 years later.
That's right.
Okay.
So first guy, his $1,000 a month, he's contributed $60,000 by the end of 5 years. That continues growing at 5% a year until 10 years in, he has over $87,000. Guy number 2 starts saving at year 5. And he saves $1,000 a month for the next 5 years. And he earns 10%.
Oh, double what the first guy's
Double
earning.
what the
Wow.
first guy is earning. He only ends up with $77,400
And the first
at
guy
the end
had
of 5 years from when he started. 10 years from when the first guy
That's
started.
$10,000 less than the first guy.
Yeah, he hasn't caught up yet. That's the value of time.
So this
building
makes me
wealth.
think of what Dave Ramsey always talks about, that you can put, $1,000 away for 40 years, and if you're earning, and it'll turn into $1 million.
Yeah, $100 a month, so it's
Yeah.
just over $1,000 a year.
But you would have to earn over 12% to get that.
Yeah.
But then,
every single year.
but Dave Ramsey often then says, well, what if you could only earn half that? And people think, well, what's wrong with $500,000?
Mm-hmm.
But when you take half of 12% on that $1,200 a year, guess what? You're less than half of $500,000.
You're less than $200,000.
Yeah. It's a huge difference. And so time is money.
Yes.
And the sooner that you start saving, even if it's a lower rate, means that you're going to have more in the end than someone that starts later and can even double your savings rate.
It's crazy, but it's true.
And that's the importance of life insurance, because now you're not penalized when you take your savings. Like when we bought our trailer, Michelle, we lost all the interest that we could have earned on that money that we bought that trailer with for the rest of our life. It's still going. It makes me kind of sad when I think about it. Okay. But here's the thing. If we would have had life insurance at that time and borrowed that money from the life insurance policy to buy that trailer, we would still be earning money on that. And then when we sold that trailer, we would have had the money back that we paid for it, because we sold it for just a couple $100 less than we bought it for.
Mm-hmm.
Yeah. That is the essence of life insurance. That is why it is the best tool to keep your savings in.
Luke chapter 9 tells the story about the guy who wanted to follow Jesus, but he wanted to wait and bury his father. History suggests that his father probably wasn't dead yet. So he
Or
he
even
didn't-
close to dying.
He didn't want the family pressure for his decision.
Yeah.
And so he was going to wait. He was going to delay. Same thing for people who delay starting their savings program. They're going to face a cost for that in their wealth.
Yeah. We talked about resolutions in a podcast earlier this year, and that's the difference with a lot of people. Oh yeah, I want to save some time, or I sure would like to leave something to the family, but they make no plans and make no goals to make that happen. Procrastination is the assassination of your dreams. You've got to start now. Otherwise, you lose all the growth and all the profitability that is between now and the time that you maybe might start.
Plus, you really cut off the end years where the exponential growth can happen, because wherever you start, that's where you have to start. Whether you start now, whether you start in 5 years, whether you start in 10 years, you're just cutting off the exponential growth at the end.
You are.
That's right. It takes faith knowing that the future is going to be better because we started today than tomorrow. If cigarette smokers understood that every cigarette they smoked took 7 minutes off their life right now, and every day got shorter by 7 minutes for every cigarette they'd smoke, they'd stop smoking tomorrow. But it's on the end that it kills them. And they don't see that. They can't see that far into the future. And so they continue their habit. It's the same thing with people that don't start saving. You've got to save now. Otherwise, you're never going to be as wealthy as if you did.
So really, time is of the essence, whether you're heading in the right direction or the wrong direction. The problem is, if you don't know, then you're going to end up in the wrong place. So whether you have a savings program that you need to have reviewed to make sure you're headed in the right direction, or whether you need to start a savings program, you need to do it and do it now.
If you need help setting up a plan to save, or if you have a plan already in place and need to see if it's being profitable for you, then we can help you. At McPhee Insurance, we both sell and review life insurance policies. You can contact us at team@mcpheeinsurance.com and we can help you.
Time is ticking. If you need to make adjustments to your savings program, do it now.
We've talked about the blue ring, protection, and the green ring, savings. Next week, we talk about the yellow ring, debt. There's good debt and there's bad debt. I would wager that when most people think about debt, they're thinking about the bad kind. We're going to talk about both types next week right here on Wealth Talk.